So these are two areas now where I can look at the market and start to make decisions. Okay? Now, because remember, we have no idea where the market's going to go. Remember in the opening example, the market is moving up. It retraces down. It moves back up. We have no idea if once the market gets back to this level here, we have no idea if the market is going to continue higher. All we can do is either make a trade or stand aside based on our trading methodology. And I notice I didn't say system. I said trading methodology. What that means is our tactics, how we're approaching the market. I really don't believe in trading systems per se, because I think they really allow the trader to forget about the market, to stop looking at the market in a common sense way, and they can be used as a crutch. So it's not to say that eventually you can trade with the system. I just highly suggest traders really more approach the market from a practical standpoint and then add on what we would normally call system elements or aspects of a system later. So again, if we don't know that the market is going to reverse here, how on earth can we make a decision? Well, first of all, we need to gain an estimate. Now, my estimate would be if the market is down here, that it is going to return to the high. That's my initial estimate. So my estimate for the week is going to be based on the prior range. If it breaks, if it comes down here to the low, well, you know what, it's probably going to trade back up here to the high. If it gets up to the high, well, you know, it's probably going to trade back down to the low. And then if the market does manage to break the low, then you know I've got some estimates for that as well. But that's my basic estimate. I also use an estimate with individual positions. And I use estimates so that I don't get into trouble. In fact, one of the most common questions I've been getting of late is based on the way I analyze a short-term trade. Remember, I look for a 2-to-1 risk-reward. So what that means is if I'm looking to go long here, which was about 98.50, and I'm thinking that the market is going to get back up to this resistance level at 99.20, I've got a range here. Okay, let's just say I'm looking at a 75 pips worth of range. Well, if I see that there is some resistance in this area, and I expect that may be strong resistance, then I need to look at what my risk is. Well, if I've got a risk all the way down here to 9,800, so I've got 50 pips worth of risk, and I'm only looking to gain 30 pips worth of reward as a possibility, that's not enough. I need to see if I'm risking 50 pips that the market at least has the possibility of moving 100 pips. Okay? Now see, the mistake that most traders make, and the mistake that the traders who keep asking me these questions are making, is that just because I'm looking at the 50 pips and the 100 pips is that I'm going to take the full 100 pip profit, or I'm going to take the full 50 pip stop. This to me would be a worst case scenario. This to me would be a best case scenario. But in the end, it's really just a guideline. Every rookie trader wants to stuff the market into a nice, neat box and make it easily describable, make it easy to trade, and I'm just here to tell you that it's not. There's no easy way to do this. And believe me, you can just do a search for money management. You're going to find over 50 books. I studied this for years, and my opinion is nobody has a good handle on it. And I'm talking about even multi-billion, multi-trillion dollar funds. They don't have a lock on money management. All they can do is manage the risk the best that they can. Don't let it get completely out of hand, and then hope for the best. That's really all we can do in the marketplace. Remember, there are no absolute guarantees, and believe me, I've been around this business long enough to realize when somebody is asking me repeatedly about my risk-reward ratio and about how statistically things don't match up, that is absolutely a person that's looking for a sure thing. That's somebody who has a problem with taking risk, and they have a problem with the possibility of losing money. And what they want, and I'm not saying it's a bad thing. It's natural for all traders, and what they're trying to do by continually focusing on making this an exact science, Meaning if they measure 2-to-1 risk reward, well, by golly, if they have a 50 pip stop, they're going to take the 50 pip stop, and they're not going to get out at 98 pips. They're only going to get out at exactly 100 pips. Even if the market is shouting at them, get out, when they're at 85 pips, they're not going to get out. And even if the market was saying, hey man, this thing's going to go down, we're going down big time, when the market is at 25 pips, they're going to hold out for 50.